Welcome to my channel. Today's video is going to be a request from 2Ryan_XO requesting a deep dive, my opinion, my analysis on Roundhill's 0-day time expiration strategy from QDTE and XDTE. Before we get started though, legal disclaimer, this content is for information and educational purposes only and is not financial advice. I am not a licensed financial advisor or tax professional. All opinions are my own and may be incorrect. Trading and investing involve risk, including loss of principal. So please, always do your own research and consult a licensed professional before making any financial decisions. Remember, I am just some random idiot you found online, and I could be completely wrong. Now, with that out the way, thank you to 2Ryan_XO for leaving a comment and requesting this. I'm sure this would make me a better investor as it would make you a better investor. Let's fact check each other. I might have got a few things wrong. So let's get started. All right, quick sneak peek of the two ETFs. Again, this is how I've digested and what I read and how I broke it down, how I understood it, right? So, Roundhill Innovation 100, QDTE, and the SP 500 XDTE, 0-day time expiration, cover call strategy ETFs utilize a synthetic architecture. They are designed to monetize intraday volatility for you while seeking to retain that overnight equity beta, right? My recommendation here is conditional approval for tactical income sleeves, right? If you're new and you're just getting into the income space, I would say you no more than 3 to 5% weight of your entire portfolio. um Maybe if you're a little bit more experienced and you're just trying to add another, diversification, I would say 5 to 10%. But if you're new, you're like, I'm not really sure, I'm just getting into the income field, I found these two, this is what I think of it, can you do a deep dive, and this is what I'm going to think of it. So if you're a newbie, no more than 3 to 5% for these two. um and I'll explain why. My view, of course. All right, these represent a structural evolution from the legacy monthly cover call funds like QYLD and XYLD, right? By trying to solve the capped gap up problem. However, realize that the long-term returns rely on the night effect persisting. Since zero day time expiration, markets are young and VPR harvesting is concentrated, premiums could reduce. And a warning, due to reliance on return of capital for those high headline yields, do not treat these as your core equity replacement. And I should have put what our VRP means. It's short for volatility risk premium. It's basically the extra return investors expect for bearing volatility risk, like selling options, right? So um it could change day to day. That's why it's an intraday um, strategy. So the fund strategy is literally um, buying or selling at the open at 9:30 a.m. Eastern time, and or buying and selling at the close at 4 p.m. Eastern time. All right, this is my personal scorecard. Um, the strategy mechanics, a 4 out of 5. I'm gonna say my analysis assessment is strong. Daily 0 day time expiration structure. Maximize your data capture, and minimize that path dependency risks of monthly funds. So if you're looking for something that does daily options, yeah, it's pretty good. 4 out of 5, not bad. Yield, quality, and tax, I'm gonna say like a 3.4 out of 5. I'm mixed on this, right? That high headline yield is attractive, but the heavy reliance on return of capital, often 100%, raises sustainability questions for you. Nav risk, this is where it gets kind of, all right, you're gonna have to be careful with this one, right? And it's in a strong, unstoppable bull market, very good. But in a choppy to downward, I'm gonna say right now a 2.9. I'm gonna say have caution here. This is the major risk here. There is no downside protection. High distribution in down markets equals destructive rock for your portfolio. Portfolio construction, I'm gonna say 3.7 out of 5. It's good, right? Synthetic replication is capital efficiency, allowing for potential collateral interest income for you. Operational so far, it looks really good. 4.4 out of 5. I'm gonna say excellent, excellent, right? Validated by over a 1 billion assets under management. And that just means OCC clearing mitigates your counterparty credit risk. So you don't have any troubles buying and or selling at almost at any given price. Right? Structural analysis and conditional advantages, right? So I'm gonna break it down into three parts. The first is the synthetic long, the beta. The mechanism behind this is that they purchase deep in the money um, call options to replicate the index price movement for you. In the money, the risk is that you have to watch out for basis risk. In a crisis, flex spreads widen, decoupling NAV from the spot price, right? So remember, they're using synthetic, they're using flex options, right? The uncapped overnight, the mechanism behind this is that they sell 0 daytime expiration calls at the open and expire them at the close. So really, you could you could only hold it long position overnight. That's considered like holding it for a while. Is that overnight is literally like close at the market. What happens at from the closing of the market? So like I think for most brokerage, for most trading, 8 p.m. or 10 p.m. Eastern time, and then at the open it completely changes. You could get a gap up or gap down. The certainty is conditional, right? They seek this, but extreme volatility could force overnight hedges, capping your upside. So if something pops off, the United States gets attacked, the United States attacks somebody, or something happens in the Middle East, all of that, snap of a finger, and all your gains could get erased overnight, right? Yield floor, which is the collateral, right? Mechanism behind this is that your excess cash is invested in short-term instruments, most likely like T-bills, right? Implication of this is that it's rate sensitive. If rates go to zero, your distribution could fall 30 to 60% unless volatility stays high. So it's very Federal Reserve rate dependent. All right, scenario analysis. Again, this is going to be my opinion, right? I'm kind of just formulating how your cover call could perform and your distributions and how it which market would be the best for you. So Goldilocks, the slowed grind up plus 0.2% per day, right? Max profit, um, great alpha, you capture index gain plus premiums, your NAV stable and growing. And a choppy and flat market, right? Sideways 0%. Um, it's I'm gonna say it's gonna be max profit. This one it could go either way. Max profit. I'm just gonna give it the benefit of the doubt. Max profit. Um, Net fund outcome. The yield. Your returns come purely from VRP plus collateral. Your NAV impact. I'm gonna say is still gonna be stable. Intraday rip. Right. Explosive rally plus 2%. It's a loss gamma, right? Underperformance, short call losses offset your long gains. Cap applies. Your NAV impact is going to be a drag. You gap up overnight, jump plus 1%. Profit loss is neutral. You have beta capture. You capture the full overnight move. Your NAV impact growing. A bear crash, right? A sharp drop of 3%. You might profit. I'm gonna say you have some downside protection. Premium buffers you slightly, but NAV drops. This is the erosion part. So you kind of make the money, but at the same time lose from capital appreciation. Is how I think might happen. A lot of them, a lot of it could change just depending on what type of in the money or out the money calls they have. Right. So I don't know the exact strategy they use. If you own it and if you've seen it, if if any of this makes sense or kind of applies, you let me know, or you can say it's completely wrong. Because this is just my scenario analysis. Again, this is my analysis. It's illustrative purposes. This is what I think could happen. Right, we do pair comparison, right? The 0 day time expiration landscape. We're going to be comparing it to It's equals. So from yield max index and defiance, right? So um, the Roundhill primary strategy, synthetic. Yield max also uses synthetic. Defiance uses daily call spread, right? It's the new strategy for them. Um, zero date time expiration usage. Roundhill sells zero date time expiration calls on the daily. So does yield max, and so does defiance, but they use call spreads. The upside capture, Roundhill, you're capped intraday, uncapped overnight. Yield max, capped intraday, uncapped overnight, so the same. And then Defiance, capped intraday, uncapped overnight, so all of that the same. Liquidity, Roundhill is the titan in this field with high 1 billion combined. It's completely dwarfed the other two, right? Yield max is under a million, and Defiance is under 2 million. So in terms of liquidity, asset under management, Roundhill is the absolute titan in this space. Structural distinction and risk. This is again how I see it. I say Roundhill's uniqueness is that Roundhill uniquely uses unbalanced short calls instead of vertical call spreads. This preserves the maximum premium harvest for you, right? However, I think this is the trade off, right? However, this exposes the fund to fully convexity during intraday upside shocks. Competitors like Defiance and YieldMax use call spreads to limit short gamma exposure, but that materially reduces your potential income. So, what this trade off means is basically when I say that this exposes the fund to full convexity during intraday upside shocks, the fund is selling naked or uncapped calls, not call spreads, right? So um if the underlying rips higher during the day, the short calls have strong negative gamma, so the fund can lose a lot of upside very quickly, right? Or needs aggressive delta hedging. You're fully exposed to the sharp up moves while being um a short option. And so how does that compare to the competitors like Defiance and Udmax, right? So like these other funds or ETFs, they sell a call and buy a further out of the money call, right? That's a call spread. That long call caps how bad the short gamma can get in a big rally. So basically, the other funds are using a call spread to reduce the risk. But because they can spend their premium on the long call, the net option premium, the yield is lower. So some funds accept more risk in sudden upside moves to collect higher option income, while the two competitors Umax and Defiance cap that risk by using call spreads, sacrificing some income for better protection. So you just have to pick and choose which trade-off you want, how you want to play it, how it's going to fit your portfolio. Um, yeah, it's definitely going to be your strategy preference because remember you're buying the strategy, right? You're not buying the yield, you're not buying the name. All right, I say this a lot. You are buying the fund's strategy, and that's what matters most. Right? Taxation, regulatory, and structural caveats. Right? There's no guarantee. While broad-based index options generally qualify for Section 1256, the specific use of flex options, which is synthetic, right? That's when I say synthetic, is typically like flex options. Introduce complexity. We haven't seen an IRS letter confirming for you yet. I don't think I found anything. But if you own this, and you've gotten one, let me know because I don't think any when I say for you yet, I haven't seen anything in terms of the IRS giving out these type of specific paperwork. I haven't found anything online. Constructive sales, the IRS might view the deep in the money call plus short option calls as a straddle, which could defer your loss recognition or alter holding periods. I have a personal accountant that handle these things for me. Um, if you are willing to spend the money, that's on up to you. But in terms of anything related to taxes, I have a personal accountant that handles all of this stuff because I own um, a decent amount of stocks, and I have property and other side businesses. I have a personal account. So you might want to get a personal account or see how much it would cost, build a relationship with them, and hey, let them know what you're doing. You're an income investor, and then you possibly have to deal with these stuff, and go on from there. All right, and then the return of capital complexity. Current what I think is right now is current 100% return on capital suggests distribution exceed NII, which just means net investment income, right? That NII is just, in simple terms, um, profit from investments like dividends or gains after expenses relevant for taxes. So we have to be careful with that. There's nothing wrong there. Let me say this: there's nothing wrong with 100% return on capital. However, if you start seeing the NAV slip consistently, re- uncorrelated or not related to the underlying or to the stock market performance, then we should start worrying. That is a sign of NAV erosion. That is a sign of them just paying you out your own money while you paying the expense ratio. Not expense. The yeah expense. Is this expense? It's the fees. So you're basically losing money. On top of that, at the end of the year, if it's not 100%, like let's just say it's 95% return on capital, that 5% you're paying taxes on, just so you know. So if it's 100%, it reduces your cost basis. You need yeah, like I said, you need an actual account to avoid overpaying taxes later, or hopefully writing a lot of things off if it's possible. All right, my final verdict, I'm gonna say status approved for watch list, approved for tactical deployment for those who are seasonal investors. Right, XDTE and QDTE are significant evolution from the Gen 1. By isolating intraday VRP and capturing overnight beta, they solved the legacy gapped up defect for you. Well, listen, they are not free money, they are complex. Path dependent instruments converting volatility into cash flow, often at the expense of your NAV stability. Okay, you have to you have to um understand that these are not your core, and I wouldn't even say these are your core satellites. These are more of your satellite positions, unless you are a seasonal investor and you know what you're doing. So yes, in the beginning I said anywhere from 3 to 5%, but max allocation 5 to 10% of your total portfolio if you know what you're doing. The role for this, in my opinion, the role for these two ETFs would be substitute for high yield bonds or tactical income sleeves, which just means if you know what you're doing, a core satellite. If you don't, I would say a satellite position. Do not use a substitute for core beta. Um, for a core position, SPY-I, QQI, right? These are not core positions. I would not put them as a core position. They are too um coin flip, right? To so to speak. They depend on a lot of the market conditions. And this is just something I wanted to put in. I didn't know if I should have put it in here, but I just put it in here just for you. Collateral transparency. I recommend you request the confirmation of the exact vehicles, right? T bills versus money market and current yields. You can actually email Roundhill and or like other funds, Neos. Um, I believe I've messaged who owns Eggy, the EGGS, EGGY. They've never responded, and so I kind of had a bad. They kind of left a bad taste for me. So you can actually email these funds and be like, hey, look, can you clarify the tax treatment describing your perspective? How does the strategy work? Can you clarify can you clarify and get specific with how your 0 date time expiration options are selected? Can you explain how the distribution are classified? How is the win rate calculated? Before investing, you know, me, I'm Mr. 2 Ryan _XO. I'm a shareholder of this. I own 1,000 shares. I would like to understand how strikes are chosen and how the win rate was measured. Is there a methodology document? So they should respond to you, right? They're not they shouldn't ignore you. If they ignored you, try again. If they ignore you the second time, that to me is a red flag. Why are they ignoring a shareholder? Right? So they shouldn't ignore you. But I've been ignored by whoever owned Eggy or Eggs. I forgot who owns it, but they never respond back to me. So whatever, screw them. Overnight hedge policy, right? We need confirmation they ever hold short options overnight during extreme volatility. You can always ask that. Right? These are just questions you can send an email to them or however you want to contact them. Right? Historical win rate, flex liquidity stress test. Right? How did spreads behave during August 5th, 2024 spike? We need data. Please send it to me. Please email it to me. So or they can tell you, hey, it's on this site. Click this link if they have it. I didn't find any. Thanks for watching. Subscribe, comment, like. If you found this deep dive helpful, smash that like button and subscribe for more institutional grade due diligence. Let me know in the comments. Are you buying, selling, or holding Roundhill's 0 daytime expiration ETF? Thanks for watching. I appreciate you guys. Catch you guys on the next. Stay tuned.